I welcome everyone to the annual shareholders meeting. Our chairman, Captain Jack Sparrow, is running a bit late and he can be here any minute. Now that our captain is here, I'll go through some of the highlights for this year. Our market cap for this year is $115 million and we had a positive EPS of 41 cents per share. However, we all feel sad that our share price hit an all-time low of $4.75. There is no need to panic. Although our share price is at an all-time low, we still had positive EPS and positive ROE. Our credit rating is one of the best in the industry. We have lots of cash on hand and we have the lowest debt in the industry. And if you look over the period of last 6 years, Captain Bootlu managed to have the second best weighted average of EPS and ROE in the industry. As far as we are concerned, the financial health of our firm is pretty strong. Now coming to the competitive strategy, Asia Pacific is one of the key geographic regions for us. Our entire production is set up in Asia Pacific, and North America and Europe Africa will continue to be the key markets for branded footwear. And we want to strengthen our foothold in these geographies. The internet segment has been growing steadily over the past 6 years, and even we have seen our sales over internet grow steadily. With the newly acquired celebrities, we think that in the future our internet sales are going to take off. When we started, we wanted to be a low-cost operator, but we had to change our strategy in between due to some unseen hurdles.
I mean, what happened, Joe?
No, Mr. Joker, nothing of that sort happened. Seeing the excess supply in the industry, we had to re-evaluate our strategy. So we chose to follow a differentiation model where we try to differentiate ourselves from the competition by offering more number of models and better SQ rating. However, our rivals reacted with low prices, increased rebates, and overall in the industry, the marketing expenditure actually increased. So going forward in the future, we will try to strengthen our branded label. At the same time, we will try to selectively participate in private labels where we earn margins. As I've already mentioned, the industry is actually seeing a turmoil and there is always a risk of reduced margins across all companies. With that, I'll hand it over to our CEO, Vivek Sinha.
So as Satish mentioned, we have been going through a difficult phase for the past 6 years. We initially pursued a low-cost and high-volume strategy and therefore maintained plants in Asia Pacific, North America, and Latin America. In fact, at one point, we had a capacity of over 11 million shoes. However, many of our competitors also expanded aggressively, resulting in an industry-wide excess capacity. Everyone cut on price, putting pressure on the margins and impacting our bottom line.
If we don't deal with this now, soon little Gamble here won't be able to get a nickel.
Yes, we dealt with it. In fact, we initiated a restructuring program wherein we sold off 40% of our capacity and consolidated all our manufacturing in Asia Pacific. This not only lowered our cost to $16 a pair, but also helped us pay back most of our debt. We were in a really good shape.
Really?
Yes, for the most part. But this year was an exceptional year because we experimented with SQ rating 1. That did not work out so well. So next year we will go back to SQ rating 5, and we have also plans to invest in styling features and superior materials, and hopefully that will put us back on track. So that's all I have for you, and I would now pass it on to Kirtana to talk about our marketing initiative.
Thank you, Vivek. So from a marketing standpoint, there were multiple things that we did. We saw a steady increase in the overall marketing budget, and this was through the years. Initial few years we did not plan on having this marketing budget become high, but since there was so much of competitive pressure, there was a specific swell in the advertising budget because of the requirement to supplement the celebrity bids that we had made and make sure we were getting the best out of that. So one thing that needs to be noted at this point is we didn't invest too much on corporate social responsibility. In fact, we didn't do anything to give back to the society or didn't focus on any charitable ventures. So this is something that we'd like to think about in the years to come.
If you're good at something, never do it for free.
Oh yes, Mr. Investor, that's just one thing that we're thinking about. There are a lot of other ways that we can do this. Anyway, moving on to the strategy after year 13. As Vivek and Satish said, there was a change in the direction that we were taking. We were taking a differentiation strategy, which means we had a high marketing budget, in fact the second highest in the entire industry. We had high rebate offers, high retailer support, and we were pushing the entire capacity we had through the retail channels. We did not offer any free shipping. We did not increase our rebates too much, but we still maintained it much higher than the industry average.
Forsaken spit of land, you forgot one very important thing, mate.
Oh yes, thank you, Captain Jack. At the end, when we finished in year 16, we had won so many celebrity bids that we actually had 6 celebrities to finish with. And that's going to give us a lot of leverage to play with in the years to come. Now that I've given you the marketing update, I'm going to pass it on to our CFO, Captain Kumud, to talk about the financials.
Thank you, Kirtana. It's true that our stock price tanked a little bit in the last year. Things aren't as bad as they look. If you look at the bottom chart, which shows the EPS expectations of the investors, we fell marginally short of the investor expectations, but still our EPS aggregate EPS numbers are still the second best in the industry. As a matter of fact, in the year 15, our market capitalization was highest among our competitors.
Let's wind the clocks back a year.
Oh yes, Mr. Joker, I know exactly what you're talking about. I agree that between years 12 to 14, we are not able to generate enough returns for our shareholders, but we have to consider the fact that none of the companies were able to do that in that duration. And in the year 15, because of our increased emphasis on bottom line, as suggested by our chairman, we were back on track generating 5% as ROE for our firm.
Did everyone see that? Because I will not be doing it again.
Okay, so moving on to the credit rating of our firm. As you can all see from the chart, our credit rating declined a little bit in the beginning, but due to our good financial health, we were able to pay off a lot of debt in the later years, and as a result our credit rating were back up to B- levels, which we consider as a very good performance considering the other firms were not able to do that. We also did not pay a lot of dividends to our shareholders in the beginning years, but we hope we will be able to do that in the later years as we have a lot more cash now. And
Take what you can. Give nothing back.
thank you, Captain Jack, for sharing your valuable insights. I believe a lot of our shareholders are waiting outside to meet you.
With that, we'll open up for any questions that the shareholders have.
I know why you choose to have your little group therapy sessions in broad daylight.
We understand your concern, Mr. Joker, but we would like to give the other shareholders a chance to ask their questions.